Imagine a scenario where I would inquire about your knowledge of stock trading. The first image that pops into your head might probably be the iconic New York Stock Exchange trading floor. This vibrant picture is a powerful symbol of stock investment activities. This is a stage where traders physically convene to transact shares, seeking profitable agreements for their patrons and companies, while vociferously broadcasting stock names and their respective prices. Previously, this was the standard mode of trading. However, modern times have ushered in a digital era where a majority of these transactions can be carried out online. Technology has evolved so much that it allows everyday people to partake in stock trading right from their homes in an attempt to turn a profit. Even though trading fundamentally revolves around stocks and other types of investments, it is generally perceived as a practice that stands apart from investing. The activities you or I would perform when buying or selling shares is likely quite different. There's a clear distinction between a trader, either professionally or as a hobby, and being an investor. Many tales of immense wealth earned from trading circulate, but the truth is that this arena is best sidestepped by most. The reasoning behind this stance will be explained and elucidated further in this simplified guide. Plain bagel. Analyzing the literal definitions of investing and trading won't necessarily provide a clear-cut distinction between these two practices. In essence, investing is allocating money towards something with an optimistic expectation of yielding a significant return or advantage in the future. In contrast, trading pertains to the act of purchasing or selling investments. There's an inherent lack of clarity about the differences. Technically, there is no official demarcation to delineate what constitutes trading versus investing. However, the usage of these terms often implies two dissimilar methods of earning profit from investments. Investors are individuals who allocate their money into certain assets with an eye towards gaining profit from its gradual growth over time. Traders, on the other hand, aim to profit in the short term by frequently buying and selling shares. Their approach banks on market volatility rather than gradual appreciation. Being a trader can entail various things. Numerous companies employ traders to facilitate their investment decisions. For instance, if an investment firm wishes to buy shares of a certain company, Plain Bagel Co., they would employ a trader to secure the shares at the best possible price. However, this discussion will be centered around traders who function with the primary goal of generating personal profit. Two significant points of divergence between trading and investing are the timing of trades and the analysis of stocks. Investing is often viewed as a long-term strategy, whereas trading is short-term oriented. Investment in a company's stocks is made on the assumption that the company will grow over time through an increase in assets or profits. Even though the duration of investment can be brief, the intention is generally to sell the stock after several years. On the other hand, trading adopts a fast-paced approach, seeking to capitalize on short-term price fluctuations. Certain types of trading, such as day trading, entail buying and selling stocks within a single day. Swing trading, however, expands the time frame to a few weeks, months, or even years. Regardless of the style, trading generally operates within relatively brief periods and often involves numerous transactions. This constant buying and selling doesn't solely characterize someone as a trader. The other distinguishing factor is the analysis. To appreciate how the examination of a company and its stock price differs between traders and investors, we must clarify the difference between a stock's price and its intrinsic value. From a theoretical perspective, a stock's price merely reflects the aggregate interaction of buyers and sellers trading that particular stock at a specific moment. Beyond this transactional price, there exists a hidden intrinsic value, the true worth of that stock, the knowledge of which is reserved for an all-knowing entity. Over time, the stock's price should ideally align closely with its intrinsic value as buy and sell activities incorporate known company information into the mix. However, human emotions such as fear or greed may occasionally cause the stock's price to veer away from its actual worth. Within the investment landscape, there are two distinct strategies that individuals adopt when it comes to handling this information. Passive investors tend to disregard transient fluctuations in stock prices and concentrate their focus on reaping benefits from the mounting intrinsic value. They operate under the belief that even if they purchase an overpriced stock, they will eventually gain in the long run as the collective market grows. In contrast, active investors endeavor to approximate a stock's intrinsic value so that they can buy the stock for less than it's worth. This strategy allows them to profit not just from the surge in intrinsic value, but also from the price's return to its rightful intrinsic level. Although these two approaches differ from each other, they both essentially rely on an increase in a stock's intrinsic value. Traders, however, concentrate solely on the stock's price. They do not seek to estimate the intrinsic value of their stocks. In fact, numerous traders engage in buying and selling stocks with scant knowledge of what the company does. Their primary objective is to capitalize on short-term fluctuations or trends in the stock's price. Consequently, traders commonly center their analysis around technical indicators, which are tools that consider only historical pricing data to assess the trader in identifying an emergent trend or pattern that they can profit from swiftly. This conjures up images of a professional trader surrounded by multiple screens, engrossed in graphs and charts while transacting stocks. A few traders do integrate qualitative data into their research, but this is usually to leverage an expected short-term shift in the stock's price. For example, if a trader learns that a company is slated to announce news next day, they might choose to buy the stock, anticipating that the company's announcement will be positive and consequently propel the stock's price upwards. In either scenario, traders typically focus on small segments of a company's information, rather than striving to build a comprehensive understanding of the firm's operations. Hence, these are the two principal ways trading differs from investing. It necessitates a starkly different mindset and functions within a highly dynamic, competitive landscape. Some might argue it even requires a certain amount of bluffing, a phenomenon that was more prevalent when traders used to negotiate in person about the stocks they intended to buy and sell. Even in today's world, traders often attempt to camouflage their true intentions when they place an order. If they can convince other traders that they have no desire to purchase a certain stock, they might be able to acquire it for a cheaper price. This inherent complexity and deception make trading an incredibly attractive venture, especially for novice investors. The allure of competition, swift transactions, immediate rewards, and the persistent bombardment of online ads featuring millionaires flaunting their luxurious lifestyles, all attributing their wealth to a minimal trading strategy, may make trading seem like a relatively easy and lucrative domain to venture into. Nevertheless, it is crucial to highlight that trading is an inherently risky pursuit. Traders tend to invest a significant portion of their funds into individual trades, occasionally even resorting to borrowing to amplify their returns. This scenario leaves them particularly vulnerable to the short-term volatility associated with individual positions. Furthermore, trading demands considerable effort and time, with numerous trades often resulting in only minuscule percentage point gains. Consequently, traders are incessantly recycling their funds into fresh positions. When it comes to novice traders, the truth remains that the odds are generally stacked against them. The constrained time frames often force them to make decisions based on fragmented information. When you add into the equation the competition from seasoned industry professionals equipped with substantial resources, advanced research, and industry-leading algorithms capable of trading at lightning speed, the contest is hardly balanced. This does not imply that you cannot profit from trading. There are individuals who manage to earn a full-time income from trading right from their homes, and some companies even provide salaried roles for traders. Hence, the field does hold certain merits. However, trading can be compared to a game of poker. While it's possible to excel at it, and indeed some people earn a living from it, there is a significant element of chance involved. When you're up against formidable opponents, the probabilities often don't work in your favor. Therefore, most advisors would probably recommend investing as a more viable strategy for the average person. With more thorough research and a long-term holding strategy, you stand a better chance of profiting from the overall growth of the economy and the stock market. True, you may not experience the same adrenaline rush as you would from an over-leveraged speculative bet, but that's likely a positive thing. After all, if you're seeking the thrill of high stakes with not so great odds, you might as well head to a casino where at least complimentary drinks are on offer. Thank you so much for watching and engaging with our content. We really appreciate your support. Don't forget to hit the like button if you found value in this video. And if you haven't subscribed yet, we'd love for you to join our community by clicking that subscribe button. Also, make sure to turn on notifications to stay updated with our latest uploads. We always enjoy hearing from you, so please leave your comments, questions, or suggestions below. Remember, we're here to help you navigate your journey. Until next time, stay tuned and take care.